All right, welcome to today's Explainer. Today we are tearing into Par Pacific Holdings. You probably know it by its ticker symbol PAR. Now, if you follow the energy sector at all, you know this company has been making some serious waves recently. But hey, instead of getting caught up in the headlines, we're going to conduct a full financial autopsy. We're going to look at just the raw, unfiltered data to see what story the numbers are actually telling us. Let's get right into it.
And I want to hook you right out of the gate with this single absolutely staggering figure. Plus 202.37%, PAR has seen this massive bounce from its 52-week low of $19.28. I mean, just think about that for a second. If you somehow perfectly timed the absolute bottom back in May of 2025, your investment would have literally tripled. It's wild. But, for a focused learner, seeing a vertical chart like this is really an invitation to dig deeper, not a signal to just blindly chase. A massive rally begs a big question. Is this growth actually supported by the underlying fundamentals?
So to figure that out, we're going to run this through our financial funnel. Here's the roadmap. First, we'll look at the big picture stock performance. Second, we're exploring valuation multiples. Third, capital efficiency and returns. Fourth, we'll unpack those growth rates. And finally, number 5, determining fair value.
Okay, Section 1, Big Picture Stock Performance, riding the volatility roller coaster.
We really need to see how this stock has treated its shareholders over the last few years. And man, this chart brilliantly illustrates why we call it a roller coaster. Look at this wild volatility. Back in 2024, the stock suffered a massive 54.93% nosedive. It literally lost more than half of its value. But then, look at the sheer whiplash right after. A 114.4% surge in 2025, and now, hitting into 2026, it's already up another 65.91% year-to-date. This is a highly cyclical play, folks. If you're holding PAR, you are definitely signing up for aggressive double-digit swings year in and year out.
Section 2. Exploring valuation multiples. Is PAR expensive? We already know the stock has completely skyrocketed from its lows, which kind of creates an investing paradox, doesn't it? Can a stock that just rallied over 200% from its absolute 52-week low actually still be considered a bargain by the market? Well, to find out, we need to completely ignore the stock price chart for a minute and focus entirely on what you're actually paying for the business's earnings and sales.
Now, the multiples here tell a bit of a conflicting story. Notice the price-to-earnings ratio sitting at just 6.51. In almost any market environment, a PE under 7 is screaming cheap value. But hold on, look down at the price-to-sales ratio. It's at 0.39, which is actually up over 64% from its 3-year average. And the price-to-book ratio is 1.89, up almost 30% from its historic average. So what does this mean? Well, while the earnings look incredibly cheap right now, you are absolutely paying a premium for the company's sales and assets compared to recent history.
But then we see this, the PEG ratio. Now this measures a stock's price-to-earnings ratio relative to its earnings growth rate, and it is sitting at an exceptionally low 0.01. Usually, a PEG ratio of 1.0 is considered fairly valued. Anything under 1 is considered cheap. So a 0.201? That suggests the market might be heavily, and I mean heavily, mispricing PAR's recent explosive growth relative to its current earnings multiples. It's a total anomaly, and it demands we look closer at operations.
Which brings us to Section 3, Capital Efficiency and Returns. Let's look under the hood.
Valuation multiples are really just market perceptions, right? Let's see how efficiently management is actually utilizing their capital. If we compare these two vital metrics side by side, the return on assets is a very solid 11.21%. That means for every single dollar of assets, they're generating over 11 cents of profit. But look at the return on equity, a highly impressive 29.97%. Why the huge gap between the two? Well, the data shows PRR has a debt-to-equity ratio of 0.63. Management is essentially using leverage, debt, super effectively to juice those returns for the actual equity shareholders. Almost 30% ROE, that is elite territory.
Let's break down the rest of this efficiency picture. The return on invested capital is a really healthy 15.5%. That means they're getting strong returns on the cash they deploy back into the business. But pay very close attention to these margins. We've got a gross profit margin of 7.41% and a net profit margin that is incredibly thin at just 2.62%. Refining is, without a doubt, a high-volume, low-margin game. But here is the fascinating part. Even at a razor-thin 2.62%, that net margin is actually up 129% compared to its trailing 12-month average. In this business, tiny margin expansions result in massive profits.
All right, Section 4, Growth Rates Explored. Let's talk cash and income.
Having an efficient operation is great, sure, But we absolutely have to see if the actual cash and income are expanding. And over the last 12 months, the answer is a resounding yes. Look at these trailing 12-month growth rates. Net income has jumped an unbelievable 857.43%. Free cash flow? Up over 363%. Earnings per share expanded by 294%. This, right here, is exactly why that PEG ratio we looked at earlier was practically zero. The recent earnings growth has completely outperformed historical averages.
But we've got to maintain our objectivity here. Contrast that incredibly strong 5-year net income compound annual growth rate of 30.75% with a 3-year CAGR. The 3-year is actually a negative 14.97%. This completely reinforces that story of PAR's cyclical, volatile nature that we saw earlier on the stock chart. If you zoom out 5 years, the growth looks incredible. But if you zoom out 3 years, it captures a deep, deep trough in the business. Timing and cycle awareness, they literally mean everything here.
Moving on to Section 5. Determining fair value. The bottom line.
Okay, so we know the history, we've seen the efficiency, and it all culminates in the ultimate investor question. What is this stock actually worth today? But before I show you the final valuation, let's just make sure we're completely clear on margin of safety. It's simply the percentage difference between a stock's intrinsic fair value, what the math says it's actually worth, and its current market price. As an investor, you want a wide margin of safety to protect you from being wrong. It's essentially your safety net. So, here are the ultimate valuation numbers based on a standard discounted cash flow model. With the current price sitting right around $58.30, the fair value based on PAR's free cash flow is calculated at $62.04. What does that mean? Well, the stock is technically undervalued, but it offers a very narrow margin of safety of just 6.03%. If the broader market drops or that refining cycle turns against them, that 6% cushion that can vanish in a single trading session.
However, different metrics definitely yield different perspectives. If we run that exact same discounted cash flow valuation, but we substitute actual free cash flow for earnings per share, it paints a completely different, much rosier picture. The EPS-based fair value shoots all the way up to $89.11. That would give you a massive 34.57% margin of safety. So this shows us that while the accounting earnings are incredibly strong right now, the actual free cash being generated is a bit more grounded.
And that brings us to our final, critical thought. The math shows this company is generating incredible ROE. It's experiencing rapid short-term growth, and technically it is trading below its intrinsic cash flow value. But with a free cash flow fair value of roughly $62 and a current price near $58, is a 6% margin of safety really enough to justify the historical volatility of this stock? That's the decision you have to make for your own portfolio. Thank you for joining me on this explainer. Keep learning, and I will see you on the next deep dive.